So friends, at its core, ALM is about two main things: making sure a bank stay profitable and keeping it liquid. So here you can see the two main objective written. The first is that ensuring profitability, and the second thing is maintaining liquidity. It means making sure that bank stay profitable, and second thing is that keeping it liquid. Now what does liquid means in banking? Think of liquidity as ease with which a bank can turn its asset like loan and security into cash, and how easily it can manage its liability like customer deposit. Right. So what is the meaning of this term liquidity in terms of bank? It simply means ease at which a bank can turn its asset like loan and security into cash, and how easily it can manage its liability. Right. So turning asset into cash, and the second thing is that how easily it can manage its liability like customer deposit. It is a bit like having enough cash on hand to pay your bill. If you can't access your money when needed, you could run into big trouble. Now, managing liquidity is something bank do every day. However, if things go awry, what start as a regular challenge can escalate into much bigger problem, sometimes even threatening the bank survival. This is what we call liquidity risk. Right. Again, I am repeating that managing liquidity is something bank do every day. However, if things goes bad, what start as a regular challenge can escalate into a much bigger problem, sometimes even threatening the bank survival. This is what we call liquidity risk. To give you some background, let's take a quick trip down the memory line. Back in 1980s and 1990, you can see many banks in the United States faced severe liquidity crisis, right, leading to failure and crisis. This tough period taught bank the importance of being proactive about liquidity management. Right. So this important steps taught the bank about the proactivity of the liquidity management. Right. Then around mid 2007, the financial market experienced significant turmoil. Right. The financial market experienced significant turmoil. Right. This period highlighted even more clearly that having easy access to cash, good liquidity is absolutely crucial for a bank's health. So this happened in the mid 2007. Financial market experienced turmoil. This period highlighted even more that having easy access to cash, that is good liquidity, is absolute crucial for a bank health. So during this challenging time, a few key events stood out. What were the key events? Let's see. So let's see the key event. First thing is that there was a sudden tightening of liquidity in a structured financial product. You can see there was a sudden tightening of liquidity in a structured financial product, and in the market where bank lend to each other, it is called interbank market. So there was a sudden tightening of liquidity, that is liquidity contraction, in a structured financial product or in the market where bank lend to each other. Now second thing that happened was that hidden risk from off balance sheet commitment. So here you can see increased probability of off balance sheet commitment, that means hidden risk from off balance sheet commitment. So these are potential liabilities that are not always obvious but became a bigger concern. Right. So these were the key events. First thing is liquidity contraction, second thing is increased probability of high risk, hidden risk from off balance sheet commitment, and finally many banks face such intense funding problem. Right. The third key event which happened was that many banks face intense funding problem, right, that the central bank had to step in to help stabilize the situation. So in simple terms, we can say think of a bank like a household budget. I'm just giving an example to give you more insight. So you can think of the bank like a household budget. Right. You want to make sure that you are earning money, then you are earning more than you are spending, that is called profitability, and that you have enough cash saved up for emergency, that is called liquidity. So this emergency is like liquidity, and the difference between earning and spending is profitability. When things don't line up, say you spend too much or can't easily access your saving, you can run into big problem. For bank, this problem can sometimes escalate to that point where they need help from central authority to keep everything running smoothly. Right. Is it clear? Now, to wrap it up, asset liability management is all about balancing a bank income and its cash flow to ensure it stay profitable and always meet its financial obligation. Right. So I hope this make the concept clear. Right. Now, now let's talk about the next point that we have. It's regarding the connection between the funding risk and market risk. Let's talk about it. So friends, we are diving into how liquidity plays a vital role in keeping bank stable and what happens when things don't go as planned. So imagine you run a very small business. So here we are talking about this from here, connection between funding and market liquidity risk. So imagine you run a small business, you need cash to pay your bill, right? But for bank, this cash is called liquidity, right? So the cash which we are talking about for bank, this cash is what we call as liquidity, right? But sometimes the market does not make it easy for bank to get cash quickly. Sometimes what happen, the market does not make it easy for bank to get cash quickly. That is what we call market liquidity risk, right? So here you can see this term market liquidity risk. Again I am repeating, you run a small business, you need cash to pay your bill, but for bank this cash is called liquidity. But sometimes the market does not make it easy for bank to get cash quickly. That is what we call market liquidity risk. And if a bank can't access the cash it need, then that can also affect its ability to lend money. Again I am repeating that if a bank, so this is the bank, it can't access to the cash it need, it require cash but it can't get access, then what will happen, then that can also affect its ability to lend money. Obviously it will not be able to lend, right, lend money, linking it to credit risk. Obviously it will be credit risk because it is unable to lend money. So think of a funding risk and market liquidity risk as the two sides of the same coin, both crucial to a bank financial health. That is what I want to say you, that this funding risk and market liquidity risk are both the two sides of the same coin, right? Both crucial to the bank financial health. So what is market liquidity risk? That means sometimes the market does not make it easy for bank to make cash quickly, and if bank can't access the cash, it will obviously lead to the credit risk. It will unable to pay to its pay because it is not getting the cash. Then how it can pay, right? So obviously it will cause the credit risk. Is it clear? Now let's talk about liquidity. You know liquidity, let's talk about this point, essential role of liquidity in banking sector. So liquidity is like the cash in your wallet. Bank need it to handle everyday tasks like when depositor withdraw their money or when borrower need loans. Without enough liquidity, even a small hiccup can cause bigger problem. Just like running out of cash can ruin your day. So this is what we have learned. Now the third segment we have is the Basel III guideline, right? So to help banks stay liquid and safe, regulators introduce Basel III guideline. So two important measures here are, the first is called liquidity coverage ratio or LCR. The second is called NSFR, net stable funding ratio. So what is LCR? LCR ensures that banks have enough high quality, easily sold asset to cover short term cash need, right? So this LCR ensures that bank have enough high quality liquid asset. As you know about HQLA, right? So LCR ensures that bank has enough high quality easily sold asset to cover short term cash need. Think of it as having a cash reserve for 30 days. So you can think of it like having a cash reserve for 30 days. And if we talk about NSFR, so this one looks at the longer picture, making sure bank have a stable funding structure to support their operation over the year, right? So that is what we call as NSFR, means look at the longer picture, making sure that bank have a stable funding structure to support their operation over the next year. So these ratios help bank plan better and avoid unexpected cash crunch. We will talk about it later, about detail about this LCR and NSFR. Now let's talk about the definition of liquidity in banking. So what exactly is liquidity in banking? What do you mean by liquidity? In simple terms, it is a bank ability to quickly turn asset like loan or investment into cash. Means you have asset with you. How quickly can you convert this asset into loan? Is asset into cash. Asset like loan or investment into cash. So bank need this cash to manage everyday activity, right? Like paying out withdrawal or funding new loans, right? So either deposit withdrawal and meeting loan demands. The bank need this activity. Bank need this cash. So there are two main way banks secure liquidity. There are two main way for securing liquidity. The first is increasing liability. You can see clearly written, either you increase the liability. What it means, that for example attracting more deposit from customer. So obviously deposit is a kind of liability. If you are attracting more deposit, then obviously liability will increase, and obviously liquidity will increase. Or second thing is that converting asset, means you are selling or quickly turning our investment at a reasonable cost. So basically you are selling asset, means what, you are selling or quickly turning our investment at reasonable cost. So both methods are essential to keep the bank running smoothly. Either you increase the liability, that means you increase the deposit, or you convert asset promptly. So both methods are essential, right? When I say converting asset, it means selling or quickly turning our investment at reasonable cost. Now let's talk about the role of liquidity and cost of liquidity. These two topics which we are going to study in a synchronous manner. So let's study it. So the two way we know the role of liquidity and cost of liquidity. Liquidity does not just help with day-to-day operation. It also acts like a buffer against unexpected change in the bank balance sheet. So here is the key point. It acts like a buffer. Buffer against what? It acts like a buffer against unexpected changes in a bank balance sheet. This flexibility support growth and help bank manage financial ups and downs. Right. So, but here is the catch. Maintaining liquidity comes at a cost. Right. The price you pay for liquidity depends on market condition and how risky investor believe a bank is. Right. So the price you pay depends on the market condition. Right. So in tougher market situation, if a bank can't cover its liquidity need with easily accessible cash, it might have to reorganize its finance or take on additional and often more expensive liability. So again I am repeating that liquidity does not help just with the day-to-day operation. It also acts like a buffer against unexpected change in the bank balance sheet. So suppose some unexpected bank balance sheet fluctuation happen. So this liquidity will act like a buffer there. So this flexibility support growth and help bank manage financial ups and downs. But here is the catch, that the price you pay for liquidity depends on the market condition. So two things are there: market condition and the perception of interest rate. Means what is the meaning of perception of interest rate? It means perception of the interest rate means that how risky investor believe a bank is. Right. So in tougher market situation, if a bank can't cover its liquidity need with easily accessible cash, it might have to reorganize its finance or take on additional and often more expensive liability. Right. That is what it is. So that is thing we have to think about the cost of liquidity. Right. Sometimes bank can't cover its liquidity need, then it might have to reorganize its finance or take on additional often more expensive liability. Now then comes the real world impact, that is when liquidity falls short. Let's talk about the impact of it. Right. So when the liquidity falls short, what is the real world impact? Let's talk about it. Imagine you are planning a party and suddenly need extra fund for unexpected expense. So you are planning a party and you need extra fund for some expenses, unexpected expense. If you don't have a saving account or an easy way to get cash, you might have to borrow money at higher interest rate or cancel some plan. Similarly, if a bank can't meet its liquidity need through its asset, it may have to restructure its finance under unfavorable condition. This shows how critical it is for bank to manage liquidity well. Right. So that is what it is called market condition. Right. Now so to conclusion is that, to sum it up, liquidity is essential for bank to handle everyday demand and unexpected challenge. Funding and market liquidity risk are closely connected, impacting a bank ability to lend and grow, and Basel III guideline introduce key ratios like LCR, NSFR to help bank manage these risks effectively. And remember, while liquidity is vital, it also comes with its own cost, influenced by market condition. If you found this explanation helpful, please give us a thumbs up, subscribe to the channel and hit the notification bell so that you never miss an update. Now let us come to the next segment we have. It is regarding the dimensions and role of liquidity risk management. So friends, what it is all about? So first thing is that, what is liquidity risk management? So now we know what is liquidity risk. What is this term liquidity risk management? You know that, imagine you are managing your own personal budget. So you are managing your own personal budget. Right. So you need to have enough cash on hand to pay your bill, handle unexpected expense and avoid selling your price position at a loss. Right. So what you have to do, you need to have enough cash on hand. Right. So if you have enough cash on hand, then only you managing your personal budget. Right. So you need to have enough cash on hand to pay your bill, handle unexpected expenses and avoid selling your price position at a loss. Right. So well, bank work in a very similar way. Liquidity risk management is all about making sure that a bank has enough fund available to meet its obligation at a reasonable cost. Right. So bank has a cash inflow and outflow, bill being paid and reserve fund icon. Right. So basically, why is liquidity important for bank? Why is this liquidity so important for bank? Let's answer this question. So bank have several key obligation to meet. What are the obligation? So you can see clearly written that new loan demand can be there. Right. Includes the new loan demand, or when customer came in asking for new loan, or existing loan commitments, means fulfilling, which means fulfilling promise they have already made about lending money. Then there can be deposit withdrawals, which means ensuring that a customer can withdraw their money whenever they need it. So basically these are the kind of obligations, key obligations: new loan demand, existing loan commitment, deposit withdrawal. So having enough liquidity means that the bank can easily cover these obligations without scrambling for cash. Now What are the benefits of liquidity risk management? So let's talk about the big benefits of keeping a solid liquidity management plan in place. The first benefit is the market confidence. You can see clearly written here, market confidence. So when a bank shows that it has enough cash to meet its need, it boosts the trust of investor, customers and the other stakeholders. Second thing is that, so these are the benefits of effective liquidity management. The second thing is the commitment fulfillment. What it means, that this ensures that the bank can honor all its prior commitment, be it for new loan or existing agreement. So this is another advantage, commitment fulfillment. The third is asset preservation. A bank with good liquidity won't have to sell its asset quickly at low price, right? Avoid unprofitable sales of asset at fire sale price. Means a bank which has a good liquidity, it won't have to sell its asset quickly at low price, what we call as fire sale price. You can see this word fire sale means at low price, right? So which protect its financial health. And the last option is lower default risk premium, which means with a strong liquidity position, a bank can secure fund at a lower cost because lenders see it as a less risky. Now let's talk about the last factor we have, segment 4, which is regarding the factor influencing a bank liquidity position. You know what determines whether a bank has a strong liquidity position? So several factor comes into play. Like you can see the factor written here, I will explain little bit. Like you can see historical funding requirement, means how much cash the bank needed in the past. Next is current liquidity position, means the amount of liquid asset the bank currently hold. Anticipated future funding needs, means predicting what the bank will need going forward. The sources of fund, means where the bank can get it cash, like customer deposit or market borrowing. Option for reducing funding need, means why the bank, it means way the bank can lower its cash requirement. Then we have present and anticipated asset quality, which means reliability and the value of bank asset. Present and future earning capacity, means how will the bank can generate income. And present and planned capital position, means the overall strength of the bank financial foundation. So in short, we can say that bank's ability to manage liquidity is not just about having cash, it is about understanding its past, present, future financial need along with the quality of its asset and learning. That is what we can see it clearly written here. So to wrap it up, liquidity risk management is crucial for bank to maintain a smooth operation, building trust and avoid costly mistake like selling asset at lower price. By keeping an eye on historical data, current resource and future need, bank can better navigate the financial challenges and secure funding at low cost. Now let's talk about the key elements for bank liquidity planning. What are the key elements for liquidity planning? Let's answer this question. So friends, we are going to explore the key elements of bank liquidity planning. Basically, how bank makes sure they have enough cash available to handle any situation. So think of liquidity planning like managing your own personal budget. So here is the key word, you can see that we have liquidity planning. So when I say liquidity planning, it means just like your own managing your own personal budget, right? Managing your own personal budget. So just as you plan to have enough cash for your monthly bill and an unexpected expense, bank need to plan so they always have the money available to meet their obligation. So this planning involve watching the economic climate and market trends very closely. Now that is called monitoring. So let's talk about, so what is bank liquidity planning? It means clear, you just like your plan, you have planned to have enough cash for your monthly bill and unexpected expense. So bank need to plan so that they always have the money available to meet their obligation. That is called liquidity planning, right? So watching the economic climate, market trend very closely. Now then we have monitoring economic climate and market trend. So let's see. So imagine checking the weather forecast every day so that you can decide whether to carry an umbrella or wear sunglasses. Similarly, bank keep an eye on the overall economic environment and trend in the money market, right? Overall economic climate and the market trend. Good financial management help them reduce the negative impact like sudden economic downturn and boost the benefit when times are good. It's all about being prepared. Now let's talk about the factors that affect the bank liquidity. You know that several factors can influence a bank ability to maintain liquidity. What are the key ones? The first is the decline in earning. So if a bank income drop, so it has less cash coming in. Second is the increase in NPA, non-performing asset. Think of this as loan or investment that are not paying off, which can reduce the available cash. The third is the deposit concentration, which means when large portion of the deposit come from just a few customer, that is called, since what is happening, that the large deposit is coming from a few customer, that is called deposit concentration. So just wait a minute. when large deposits are coming from just a few customers, that is a risk that if they all withdraw at once, the bank could run short on fund. Then we have downgrading by rating agency. You know that just like a lower credit score can make it harder for you to get a loan, similarly a downgrade can make it more expensive for a bank to borrow money. And then we have expanded business opportunities, which means you know what it means, that while these can offer growth and profit, they can also put additional pressure on the bank cash reserve if not managed carefully. So that is called expanded business opportunity. And finally, obviously acquisition is also included. So I am talking about all these three. If you are trying to expand your business opportunity, if you are trying to acquire, if you are trying to merge, right? So these three things, they can offer growth and profit in the long run, but they can also put additional pressure on the bank cash reserve if not managed properly. So these are the factors which significantly affect bank liquidity: decline in earning, NPA increase, deposit concentration, rating agency downgrading, and expanding and these expansion. Now what are the strategies to meet funding need? Let's talk about it. So friends, you know that how do bank make sure that they have enough fund needed when needed? So some strategies explained in everyday language. Now the first thing is they do is to dispose of liquid asset. What it means? That this means selling of asset that can quickly be converted to cash. Basically what you are doing, you are selling of asset, selling of those assets which can be quickly converted to cash. The increasing short term borrowing, which means borrowing money for a short period, just like taking a short term loan, right? You take a short term loan, right, to meet the immediate need. Decrease holding of less liquid cash, means reducing assets that are hard to sell quickly so that they are not tying up cash. Now the next is increase liability of a term nature, which means taking on long term debt that provide a steady flow of fund over time, that is called long term debt. And increase capital fund, which means bringing in more money from investors or through other means to strengthen the bank cash reserve. So bringing in more money through investor. So basically these are the way that they dispose of the liquid asset, means selling of asset that can be quickly converted to cash, increasing short term borrowing, decreasing holding of less liquid asset, increase liability of terms nature, and increase capital fund. So each of these strategies is like having different tools in your toolbox to make sure that you are always financially prepared, right? So this is how the liquidity is managed. These are the strategies to manage the liquidity. Now let's talk about the liquidity management and associated risk. So friends, to sum it up, effective bank liquidity planning is all about ensuring that bank always has enough cash to cover its obligation, whether that obligation is paying out deposit, funding new loan, or seizing new business. So by monitoring economic trend, understanding the factor that can affect liquidity, and having solid strategy in place, bank can avoid cash crunches and maintain stability. Now let's talk about liquidity management and associated risk. So this topic we are talking about now. So friends, you know that how to tackle liquidity management. So we know what is liquidity planning. What is the meaning of this term so called liquidity management? Imagine running your own household budget. You always need to make sure that you have enough cash in your wallet to pay your bills, cover unexpected expense, and take advantage of a good deal when it come along. In the banking world also, liquidity management works the same way. It is about making sure that bank always has enough cash or asset that can quickly be turned into cash to meet its financial obligation. So what are the source of liquidity? So you can see it can be, however, managing liquidity is not always smooth sailing. There are several risks involved, and these risks can come from both inside and outside the bank. So you can see internal or external source, right? So risk is always involved, right? So they might be influenced by where the bank operate. You can see geographical location, right, where the bank operate, or the overall economic system, or even the specific financial instrument that the bank use, right? So plus sometimes it is all about the how people in the market feel about the bank stability, that is perception in the various market. So these are the factors which influence, which causes risk, right, in which originate risk and originate from this factor. So let's look at the three main type of liquidity risk that the bank face. We know it very well, we have talked about it earlier, but let me remind you once more. The three kind of liquidity risk. The first is called the funding risk. Funding risk is like when you suddenly need to replace cash that has gone out of your wallet. So this is your wallet, some cash has gone out and you want to replace this cash, right? So because of the unexpected expense, so some cash goes out of your wallet because of the unexpected expense and you have to replace that cash, right? So that is called funding risk. For a bank, this happen when there are sudden withdrawal or deposit that are not renewed. For example, imagine a lot of people decide to take out their money at the same time. This could be due to fraud, a general loss of confidence. So obviously it can be due to fraud or because loss of confidence, right? Or because of some systemic issues, right? So affecting the entire financial system, or it can be because of the complexity, right? Complication with the foreign currency liability. So any reason can be there. So because of any kind of reason, lot of people decided to withdraw their money, to take out their money. So when these happen, the bank must quickly find a way to replace that cash, and that is what we call as funding risk. Next is the time risk, right? So these are the type of liquidity risk you must know. Next is the kind of time risk. You know what is the meaning of time risk? Basically, think about expecting your paycheck on a certain day, only for it to be delayed, right? Bank face a similar problem when they are expecting cash inflow like repayment on loan, right? But those funds don't arrive on time. So suppose bank expect that on 31st we will receive this much crore repayment of loan, but it does not arrive. So this delay can happen because the quality of the bank asset might have deteriorated. Some loan turns into NPA, borrower might default, or there could be temporary issue in collecting payment. Any reason can be there. You can see several reasons: several deterioration in asset quality, a standard asset turning to NPA, borrower defaulting on repayment, temporary problem in recovery. Any reason can be there. Basically, the bank might not get the money when it need it, and that time gap can cause serious challenge. So that is called time risk. The third kind of liquidity risk we have is called the call risk. So this risk come into play when a bank suddenly find itself having to pay out money because a contingency like a guarantee or commitment, this contingency suddenly turns into actual cash outflow. So basically bank has a contingency, and this contingency has turned out into cash outflow. So basically what we are talking about call risk, when you're talking about call risk, it means that when a bank suddenly find itself having to pay out money because of the contingency, because the contingency has converted into cash outflow. It's like having a credit card limit that suddenly turns into a bill you must pay immediately. So a credit card bill turns into a limit, turns into a bill you must pay immediately. This can happen, for example, when some non-fund based limit, right? Let me tell you, let me give you example of call risk where it arises. You know about this non-fund based limit, right? Like letter of credit, bank guarantee, these are the non-fund based limit. So whenever some non-fund based limit, right, convert into funded based one, or due to the complex financial instrument like swap and option, so this can be the reason, right? So this can be the reason for this call risk. For some, when some non-fund risk convert into a bill, into fund based, or due to swap and option. So when this happen, the bank might miss on profitable business opportunity because the cash it tides up dealing with this sudden demand. Right. So remember, call risk means sudden cash outflow from contingent liability. That is the meaning of call risk. So let's wrap it up. Liquidity management is all about ensuring that bank always have enough cash on hand to meet its commitment. But there are risks like funding risk, time risk, and call risk. So they can throw a wrench in those plans. By understanding these risks, bank can better prepare themselves and develop a strategy to handle unexpected cash shortage. Right. Now let's talk about the complexities in liquidity management. You know there are some complexities also in the liquidity management. So what are those complexity? Imagine trying to manage your personal finance during a really tough month, right? So suppose you are trying to manage your personal finance and the month is quite tough. How do you go about it doing it? So friends, the sudden car repair, unexpected bill, a delay in your paycheck, for bank liquidity issue can pop up in a similar complex way, where several factors hit at all once. It may happen that several factors hit at all once, right? So this is called a severe liquidity risk, which can happen. So how to go about solving such type of issue? That is what we are going to discuss it now, right? So friends, let's break down some key factors that can complicate a bank's liquidity management. Like you can see, fraud and loss of confidence. The first point you can see is a fraud and loss of confidence. Picture this: if a bank suffers significant fraud, it's like having a major hole in your budget. Now add a loss of public confidence, right? So first of all, bank is already suffering fraud, right? Significant fraud bank is suffering, and it's like having a major hole in your budget. Now add a loss of public confidence. Public confidence is also losing, right? Suddenly customer panic and rush to withdraw their money, which we call a bank run. So this double whammy can really strain the best bank cash outflow, isn't it? So this is one of the reason, right, because of this the liquidity issue can arise. You know, the reason you can see the fraud and loss of confidence. The reason you can see is the fraud and loss of confidence. Now second thing is that interbank dealing. Bank often rely on each other to keep things running smoothly. So here we are talking about the interbank dealing. Interbank dealing means bank rely on each other to keep things running smoothly. But if one bank fail to meet its commitment, it can create a domino effect. So here you can see the keyword written, domino effect, or we can call it the ripple effect. Right, that is called interbank dealing. Bank often rely on each other to keep things running smoothly. Right, but if one bank fall to meet its commitment, it can create domino effect. Other bank expecting money from that institution may find themselves short and unable to pay their own bill. It's like when a friend balls on you for dinner and suddenly everyone else is left wondering if the plan will work out. So that is called interbank dealing. So the third kind of risk is regarding the, you can see, foreign currency liability. You can see foreign currency liability, the third point here. So now consider this foreign currency liability. Sometimes a bank true financial strength is not very clear to the international creditor, right, to foreign creditor, international creditor. They might have a hard time telling what is real and what is just a rumor, which can make managing cash flow even more difficult. Think of it as trying to understand a friend financial situation from miles away. You just don't have the full picture. So this is another reason. And finally we have mobilizing domestic fund. So basically what we are covering understanding the complexities in liquidity management, right? Some key factors that can complicate a bank liquidity management. The fourth factor is mobilizing domestic fund. So finally bank might struggle to raise enough fund from local sources to cover their liability in the foreign currency. This is like having money in your local bank account but needing cash in a different currency and finding it hard to exchange or gather quickly. So this is another point. Now then we have measuring and managing liquidity risk. How to measure, how to manage this liquidity risk? That effective liquidity management is absolutely critical for bank. It ensures that they can meet their financial obligation on time and avoid getting into trouble that might lead to irreversible damage. So whether it is handling unexpected withdrawal or making sure funds are available for new opportunity, keeping a close eye on liquidity risk is the key. In simple terms, we can say that by accurately measuring liquidity risk, what we are doing, we are measuring the liquidity risk. You can see clearly written, we are measuring the liquidity risk. By accurately measuring liquidity risk, bank can make a smarter decision on how to prepare for tough situation. What are the tough situation? Like setting aside enough cash reserve, right? Setting aside enough cash reserve, making a smart borrowing choice, and ensuring that they always have a safety net. So to wrap the things up, managing liquidity is not as straightforward as just keeping cash in the vault. It involves juggling multiple challenges at once, like from fraud, shaky public confidence, to complex international issues and local funding hurdle. So but by understanding and measuring this risk, bank can make sure they are always ready to meet their obligation. Now let's talk about how to measure and manage the liquidity risk. So friends, first thing is that why is liquidity management so important? Imagine you are running your household budget. You need to make sure that you always have sufficient cash on hand to pay your bill, handle unexpected expense. For bank, liquidity management works the same way. It ensures that they pay off their debt and obligation on time. If bank run out of cash, it could lead to serious problem that might affect even the entire financial system, not just one bank. So what are the key elements of liquidity management? The first key element you can see is the crisis preparedness. Means what? Just like you might regularly check your bank balance and plan for a rainy day, bank constantly measure their current liquidity and also simulate what would happen in a crisis. They ask, what if we face sudden financial shock? How much cash would we need? This helps them be ready for any unexpected situation. The second thing is that a strong management system. What is the meaning of this? You can see a strong management system. It means that these are essential, because think of this as having a top-notch budgeting app on your phone that track every expense and alert you when funds are low. Suppose you have a budgeting app on your phone, it alert you when the funds are low. Bank need reliable information system to monitor their cash flow in real time and maintain a central control. Then we have something called scenario analysis. What is the scenario analysis? Right. So tell me, what is this scenario analysis? So there is a scenario analysis, means bank run through different what if scenario. There is something called different what if scenario. So it means what? To figure out their net funding requirement under various conditions. So bank run through what if scenario to figure out their net funding requirement under various conditions. It's kind of like planning for different weather condition on road trip. So this helps them understand how much cash they might need if things take an unexpected turn. The next thing we have is a diversification. You know what is diversification? Just as you might have multiple sources of income, say a full-time job plus a side gig. Bank also diversify their funding source. Relying on just one source of fund is risky. By spreading out where their money comes from, they reduce the impact if one source dries up. Then we have something called contingency planning. What is contingency planning? Contingency planning is all about having a backup plan ready for unexpected liquidity needs. Think of it like keeping an emergency fund that you can dip into when something unforeseen happens. So banks set aside plans and resources so that they can quickly address any sudden cash shortage. Now let's talk about putting it all together. So in a nutshell, effective liquidity management means banks are always prepared to meet their financial obligation even during the tough time. So here the keyword is by being proactive, right? By being proactive means measuring their cash position, running different scenario, diversifying their funding, having contingency plan. They not only protect themselves but also help keep the entire financial system stable. So I hope this breakdown make the concept of liquidity management crystal clear to you. Remember, it is not about keeping cash in the vault. It is about being prepared for every possible scenario. Now what kind of scenario can arise? Let's talk about it. So let's talk about developing a structure for managing the liquidity risk. So the first segment you can see is crafting a liquidity strategy, right? So how to craft a liquidity strategy? So here we are. First up is the liquidity strategy. You can see that think of this as a game plan for making sure a bank always have enough cash available. So here is how it works in everyday language. The first thing is that you should set clear target. So here is the key point. You can see set a clear target. You should set a clear target means bank set both measurable goals. So that is called quantitative target as well as the qualitative target. So when I say quantitative target, what it means? Quantitative target means that like having a specific amount of cash reserve which you can quantify. You have a specific amount of cash reserve, or suppose also some broader goal which you call qualitative target, like maintaining a strong reputation in the market. So reputation. So quantitative target and qualitative target both are there. This is called set clear target. The second strategy could be to protect against market stress, withstand the market stress. It means what? This strategy is designed to keep the bank financially stable even during tough time, just like keeping an emergency fund to cover unexpected expense. The third thing is they do is to define the policies. So here is the key point. So it means bank outline clear rule on how the bank will manage its asset means and liability, how to handle any gap between these two, and how to manage cash on different currencies or regions. So this will have policies for that. So three strategies I have told you. The first thing is that clear target. They should set the clear target, right? Quantitative target as well as qualitative target. They should protect against market stress, which means this strategy is designed to make bank financially stable. And the third thing is policy defining, which means that rule on how the bank will manage its asset and liability. So we can say it clearly that this liquidity strategy is a combination of three things. What are the three thing combination? The first thing is clear goal. Let me write it down. Is equal to, we can write it. It is equal to clear goal plus emergency planning plus defined policy. So that is what our liquidity strategy is all. Defined policy, right? Clear goal. Our target should be clear. Quantitative and qualitative target both should be clear. We should have emergency planning, right? And finally we have defined policy. Now let's talk about communication and implementation. You know what is the meaning of this communication and implementation? So once the strategy is in place, yes, once we have clearly set the strategy, so it's all about communication and implementation. Imagine if you have made a brilliant plan for your household budget but never told anyone in your family how to stick to it. It would not work, right? That is what we call communication and implementation. So what you do, you spread the word. That is communication, which means the liquidity strategy need to be clearly communicated to every part of the organization. Every team, every department, every branch should know the rules and follow the game, follow the plan. Now the second thing is that unified. Here you can see that unified approach. So when all business unit operate under the same approved policy, so you can see same approved policy and procedures. So when all business units operate under the same approved policy and procedure, it ensures everyone is working together, making the bank overall cash management more effective. So we can say that communication means everyone is on the same page. This is the importance of communication, which you can't undermine. Now third thing we have is the board oversight. So this is like having a trusted family member who keep an eye on your budget to make sure everything is in order. So first thing is what you need to do. You need to do regular monitoring, right? So here is the keyword which we call as monitoring. So it means that the bank board of director review detailed and up-to-date information on the bank performance and liquidity risk. Monitor the bank performance and the liquidity risk profile. Right? They check if the bank is meeting its cash flow goals and if any problem are on the horizon. Second thing they do is to risk assessment, is to assess the liquidity risk. Means by continuously assessing liquidity risk, the board can quickly spot any issue. So they are assessing the liquidity risk. If there is an issue, they can quickly spot. This oversight is crucial to protect not just the bank but the financial system as a whole. So we can say this board oversight is equal to two things. The first thing is that continuous monitoring. It means continuous monitoring, and the second thing is quick action. So first of all, you have to continuous monitor it, and if there is any issues, right, so you should take action before they turn into bigger problem. Means being proactive. This is the part. Now let's talk about how to build the liquidity management structure. How to build it. You know that finally bank need to set up a solid structure to put all these strategies into action. The first thing that comes into is the effective structure. You know, this means having the right team, right system, and right process in place to measure, monitor and control liquidity risk every day. Think of it like setting up a reliable home management system that keep track of your expense. So we can say that a structure is equal to right team plus process plus system. Right team plus process plus system is equal to a structure. So what is the conclusion? To sum it up, managing liquidity risk is not just about having cash on hand. It is about having a comprehensive plan that includes clear strategy, strong communication, vigilant oversight and effective structure. These all help bank protect themselves and maintain stability during market stress. Now let's talk about what are the strategies and policy. Let's talk about the responsibility. So who is in charge? First of all, let's talk about responsibility and oversight. Imagine if your household has a dedicated budget, right? Dedicated person who is in charge of managing the budget, someone who makes sure that there is always enough money available, right, for bills and emergency. In bank, this job is handled by a specific team which we call as asset liability team, asset ALM, right? So this job is handled by a specific team which is called asset liability committee. That is called asset liability committee, ALCO we call it. This job is maintained by ALCO. This committee is made up of senior management, people from treasury department or experts in risk management. So you can see senior management, treasury department, experts from risk management. So the main role is to oversee all aspects of liquidity management, ensuring that bank can always meet its financial obligation. So we can say that a dedicated team is in charge of the cash management. That is called ALCO, asset liability committee. Now let's talk about the challenge of handling foreign currency. Yes, treatment of foreign currency, super important. You know, just wait a minute. Treatment of foreign currency. Yes. So when a bank deal with multiple currency, it is like trying to manage money in different language. It add an extra layer of complexity. Here are some key points. The first thing you can see, complexity. This is a keyword here. You can see this word written here, complexity. What is the meaning? Just as you might need to translate between language, bank have to manage asset and liability in various currency. This can be tricky because each currency market operate differently. So this can add complexity. First reason. The second thing is that market visibility. The second key factor you can see in the second point you can see is regarding the market visibility, right? So what it means? It means that when I say market visibility, it means bank might not be as well known or as trusted in foreign currency market compared to their domestic market, right? So this can slow down their response to any market concern, making liquidity management tougher. The third thing is that domestic liquidity challenges can happen. Even if a bank has plenty of cash in its home country, turning that into the foreign currency needed during a financial disturbance can be really challenging. So we can say three issues are there. First is that it add extra complexity. Handling foreign currency add extra complexity. Plus there are some unique challenges which a bank face while converting the domestic currency to foreign currency. Now, what are the key decisions for bank operating in multiple currencies? So first of all, we get to know that what are the challenges, what are the problems, what are the issues. Now, what are the key decisions? So first, let's look at the key decision bank need to make while operating in multiple currency. The first decision they need to make is the clear differentiation. This is the keyword, which means that it is essential for bank to clearly separate their domestic liquidity management from their foreign currency liquidity management. So they have to separate their domestic liquidity management and foreign currency liquidity management. Right, think of it like keeping two separate budget, one for your local expense. So one budget you have kept for your local expense and other for international trip. Now, second thing they do is to develop the robust strategy. What it means? Means bank must develop a strong strategy to handle risk and funding requirement that are specific to each currency. Right. So that is called currency specific risk and funding requirement. This means planning for how to manage fluctuation in exchange rate, market condition, and other currency specific challenge. So let me talk about the key decision. It is regarding separate domestic and foreign currency strategy, develop a strong currency specific plan. Right. So these are the key decisions they have to make. Clear differentiation between local and foreign liquidity management. They should develop the robust strategy. Right. A strong currency specific plan. So to sum it up, an effective liquidity management strategy in bank involve a clear responsibility with a dedicated team, which we call as ALCO, a smart handling of the complexity that come with foreign currency, and making informed decision to maintain different currency risk. So by understanding these key elements, you are one step closer to mastering liquidity management for your BFM examination. Right. So we are just talking about the management structure. Right. So you can see the management structure here is centralized and decentralized liquidity system. So friends, first let's talk about the management structure. When a bank has to handle funding in different currency, it has several options for how to organize its operation. What are the options available to bank for organizing its operation? The first is called centralized liquidity management. In this approach, the head office is like the central command center. So this head office is like the central command center. It manages cash for the entire bank. The head office, it manages cash for the entire bank. Think of it like a big control room where everything is coordinated from one spot. The second organized structure is called decentralized liquidity management. Here individual operating division take care of their own cash management within limits set by the head office. For example, a non-European bank might let its London office manage liquidity for all its European operation. Right. So here individual operating division takes care of their own cash management within limits set by the head office. The example I've given, a non-European bank, what it does, it let its London office manage liquidity for all its European operation. It's like giving different branches of a business their own budget, but with some guideline to ensure consistency. And the third approach we have is called the hybrid approach. You know what is the meaning of hybrid approach? This means combining both centralized and decentralized. That is called hybrid approach. You are combining centralized and decentralized element. The home office handle the local currency and overall coordination, while foreign office manage liquidity in their major foreign currency. That is called hybrid approach. Okay. So for example, a non-Japanese bank might let its Tokyo office be in charge of all its liquidity need in yen. This way, each office focus on what it know best while staying connected to the central way. So I hope this make your concept clear. Now, so what we can say that in centralized there is one control. Right. So here we can say that when I say centralized means one control, and when I say decentralized, it means what? It means individual budget. Right. So centralized means one control room and decentralized means individual budget, and hybrid means best of both world. In single word I can say centralized means there is one control, decentralized means what? Decentralized means individual budget. Decentralized means individual budget. And if we talk about the hybrid, it means this is best of both the world. Right. This is the important thing. Now let's talk about the liquidity strategy in each currency. Right. So let's talk about the liquidity strategy in each currency. So what I mean to say when I say liquidity strategy in each currency, let's dive into how bank handle their liquidity strategy in each currency. This is all about planning how to meet funding need when dealing with different currency. The first thing they do is funding through domestic currency. Here you can see funding through domestic currency. Banks sometimes use their domestic currency to meet foreign currency need. Imagine you need euros but only you have dollar. You would have to exchange your dollar for euro through a foreign exchange market or use a tool which we call as a currency swap. So you have a dollar but you want euro, so we can either use currency swap or you can use foreign exchange market. So this strategy helps the bank get the foreign currency it needs from its home base. That is called funding through domestic currency. Second thing is the risk management. You know, managing money across currency can be risky. Right. So you know that managing money across currency can be risky, especially if exchange market suddenly shut down or become unpredictable. So here we are talking about the risk management. So managing money across currency can be risky, especially suppose exchange market suddenly shut down or become unpredictable. So bank develop a strategy to handle these risks so that they are not caught off guard. It's like having plan in case your currency exchange suddenly change dramatically. That is called risk management. And the third thing we have is the backup liquidity strategy. Finally, bank always prepare a backup plan. This means they set aside additional source of cash or line of credit, similar to keeping an emergency fund in your personal budget. If something unexpected happen, they can quickly draw on these resources to convert home currency into needed foreign currency. So what we can say, just I'm summarizing the fact, we can say that domestic funding is equal to exchanging your currency. So three way I am talking about. Domestic funding means you are exchanging your currency, right? And second thing is that second factor I have told you is the risk management. So risk management means plan for market shock. You are planning for market shock. And the third thing is backup strategy, which means emergency fund for bank. Overall, we can say that these are the three strategies which work, right? So basically, these are the liquidity strategy in each currency. Again, I am repeating. When I say domestic funding, it means exchange your currency. When I say risk management, it means you plan for market shock. And when I say backup strategy, it means emergency fund for bank. Now there are some factors to consider here. There are some important factors to consider here. So while making this decision, bank need to consider a few important factors. What are they? The first thing is they do is the size of funding need, right? Is the size of funding need, means how much money is actually needed in each currency, right? The second thing is that access to foreign currency market, means how easy it is to get fund in that currency when required. And the third thing is capacity to use off balance sheet, which means do they have the tool like a standby credit line ready to use when needed. So funding size, market access, or balance sheet tool, these are very important things to take care of, right? So friends, these are the factors to consider. So to summarize, bank have a few key options while managing foreign currency funding: centralized, decentralized, hybrid approach. They also develop detailed strategy for funding in each currency, managing risk, and preparing backup plan, all while considering how much funding they need and how accessible foreign market are. By planning carefully, bank can navigate the challenge of multi-currency operation and maintain financial stability. I hope you find this explanation useful. So this is all about the part 1 of the lecture, and then we will talk about the backup liquidity source for foreign currency in the next lecture, right? We will see how to set the tolerance level. This is all about we will discuss in the next lecture. So if you think this video was useful for you, we have covered essential part. So